is not off. Okay, hopefully it's better now. So how many people do we have here? Let me check. Okay, so we have 18, 21 people in here. Okay, that's great. So welcome to the seminar. How are you guys today? Okay, Marco Musil, can you talk to me, please? I need to find out if you guys can hear me, if I can hear you. Marco?
Oh?
I hear you, but somehow I plug in my earphones. I mean, earphone, but it doesn't work. But yeah, but that's okay if you can hear me. So how was the lecture today? Did you have the lecture, right? Okay, so it will be difficult if no one wants to talk to me.
Yeah, sure, we had the lecture today, but I think that like most of the people didn't go. They were like, I don't know, 20 people in total, 25 maybe. It was about the capital structure.
Yeah, it's great. So how was it?
I mean, it was okay. It was just like doing what we did, like what was already written on the lectures, like in the slides. Like same thing actually.
Yeah. So, but like around 30 people join, right? This is good.
Yeah, 20, 30, yeah, something like that.
Yeah. Okay, yeah. So in that case, because I was thinking, which lecture to start with, and Professor Hardy, he chose capital structure because it's kind of important topic, and yeah, and I think it's good to start with because like lots of people were asking me the similar questions about homework from capital structure. So I've decided that for the seminar we will follow somehow we will follow the lecture, and for today we will start with the capital structure as well, but we will go fast, right? Because you know lots of stuff about capital structures as already. So yeah, let's go briefly for the theory, and then we will calculate together the exercises for capital structure. Just double checking your homeworks, and you will know the results, and after that after that we can continue with long-term financing topic. Okay, are you okay with that? Okay, so before starting, lots of people asking me about midterm tests, about homeworks, and so on and so on. And following the Professor Hardy's email, we are not going to have any midterm test. Okay. uh, and the reason why, because I don't think it's like we decided that it's not needed to have midterm test, and we will give you points based on your activities, means homeworks, uh, homeworks and activities online in seminars and lectures. So there is no midterm test, but 30% of your mark will be based on will be based on the homeworks and activities, like if you join the lectures, if you join the seminars, you know, and so on and so on. Yeah, that's one point. Yes, thank you, Natalia. Would it be possible, please, to send the seminar number 8? Since lectures and seminars is going to be online, there's not going to be any homeworks anymore. Okay, Natalia? Okay, Natalia's not talking to me. No homework. Sorry? Because like it took me like, yeah, because lots of you didn't upload homeworks online in INSYS. Lots of you send me you know, the homework through emails, and it took me ages, you know, to download your homeworks and open it and so on and so on. So yeah, no homeworks anymore. So all exercises we will calculate through online seminars, and then if you have any questions you can ask, but there's no homework anymore. Okay, so the last homework should be you know, this week. So if you submitted capital structure and long-term financing, I will take it. But from the seminar 8 is not, is you don't have to do it. Great. And for maybe Professor Hardy already told you that, but just repeating it for, you know, to make sure that you all understand it. For the final test, we don't know if, you know, the university will be open, but we are thinking to put it online. So most probably the final test, I'm saying most probably, it doesn't mean for sure, but yeah, but like the high percentages is that the test will be online. Okay, will be online. I will create like 3 exercises, some open-ended questions, and then you have 1 hour to fill, well, you know, to calculate, to fill in all your questions, or for, you know, all your answers and so on and so on. Great. So I think I answered the most important thing. Do you have any questions about midterm tests, final tests, exercises? Okay, so I guess not. Yes.
Sir, I want to know. So it means like this week we don't have that homework.
Again, I cannot hear you well. Sorry.
Is it means like we don't have the homework this week?
So what is homework for this week?
I think it's the seminar 8, like valuation, I think. From the INSYS, it is said that we need to submit the homework of valuation this week till 10th. Yeah.
No, homework valuation not. The last homework you should submit is for capital structure and long-term financing.
Okay. So for valuation not. Okay. Thank you.
Okay. Okay, my headset doesn't work, so I cannot. Okay, doesn't matter. So yeah, when will the result of homework be available? Good question. Yeah, today we will calculate homeworks for long-term financing and for capital structure, and homework for, you know, for the previous 3 weeks. I will upload them later. I didn't have time to do it yet, but yeah, everyone who sent me homework will have like full points. So don't. So yeah, don't be worried. Just we will check your answers later. Okay. But today we will focus on capital structure and long-term financing.
Wait, sorry. So it means that like if we send it, so like we receive full points no matter what we wrote, more or less.
Okay, can I do one thing? Can we join again? Because it's like my microphone, I cannot hear you guys very well. So I will turn it off and then I will turn it on again. Okay, the seminar. So please join me again. I'm back. Hello.
Yeah, we can hear you.
Oh, nice. Yeah, I can hear you now. Okay, sorry very much. Okay, so what were you saying?
Yeah, actually, I was asking like based on what you said before, like we shut down. You said that like as long as we send everything, we will receive the 30 points. This is what you said?
Yeah, if you send everything until long-term financing,
Sure.
and you keep joining online lectures and online seminars, I will give you 30 points.
Okay, sure. Okay, thanks.
Okay. Yep. Even though, for example, if you're even though your homeworks, you can have some mistakes in your homeworks, and it's okay. I will go through it, and of course homework, the whole homework is not correct. um, I will give you less points. But if you have only 1-2 small mistakes in your homework, it's okay. I will still count it. Okay.
Okay, sure.
Yeah. Thanks. So any other questions? Okay. And so someone's asked me a very good question in the group chat, like she didn't send homeworks because she didn't know about it, because previously homework was only for 10 points or something, right? So because before we were thinking about still having midterm tests and then final tests, and so activity homework would count only for 10 points, at 10 plus 10 points, and that's why she didn't do homeworks. But now homeworks, is like 30% of your total grade. What should she do? That yeah, is a very good question. I guess you can still send me your previous homeworks, because like lots of people, at least like 30% people send me your homeworks late, and I was I still accept it. So for everyone, for each and every one of you, if you send me your homeworks until long-term financing, until the end of this week, I will still take it. Understood? Again, if you send me all of your homeworks from the beginning until now, until long-term financing, I will still take it but the deadline is the end of this week to my emails. Yeah, so I hope it is clear, because yeah, I don't want, I don't want to receive homeworks in the next 2 weeks again, and then and then explaining why I didn't give you any points. So deadline is until the end of this week. Okay, let me check if I answer all your questions. Yeah.
Excuse me.
Yes.
I have a question. So
Sure.
could you just repeat how the grading of this subject is going to be done?
Okay, great. Yeah, thank you for your question. Who are you? Sean.
I'm Robin. I'm currently on Sean's account just because we're roommates, so we have one laptop open.
Okay, that's good. That's good. Yeah, so 70% of your grades will be, based on the final test. Okay, 70%. It means 70 points from the final test and 30% from your homeworks and activities. Okay, so even
homeworks
if
and activities.
Yeah,
what exactly?
Activity means like you will join the lectures and seminars.
All right. We are using one laptop. Should I use my laptop as well, just so you have it in your data, or is it okay just whenever you see Sean or Robin, it's just that we're working together?
No, that's okay. That's good. Sean and Robin, I will remember. But for example, if you send all your homework, you will get automatically 30 points. But for example, if you miss some homeworks, but I will remember you, from the seminars or from the lecture, I will give you still 30 points. Activity is more. Yeah.
Okay, thank you.
Yep. So from when will you take attendance? From I guess from this week, right, Karaman? So from when will you take the attendance? Yeah, from this week, so on. But, yeah, but it's it's just to push you to be more active. Yeah, but don't worry about points. I will try to give as much as I can. I mean points for you guys, so don't worry too much. Okay, any other questions? Okay, if not, let's start with the seminar. Okay, so someone asked, but the final will be minimum. Oh yeah. Okay, so Malika, very nice question. So yeah, for you to pass this subject, similar to any other subjects, you need to have at least 60%. Okay, so even though you have 0% from the midterm test / homeworks, you can still get 70% from the final test, and you can easily pass. But we are not aiming for 60. We all aim for 90+%. Right, so yeah, so that's my answer. Hope I answered your question. And then, do we need to join the discussions to get the points, or it's enough to be present? Damn, you're so tough questions for me. No, I don't think you have to join the discussion, but yeah, but it's up to you. You are at the universities, you are not. But if you join, I will expect you to have some questions. But Natalie, if you already send me all your homeworks, and you are expecting to have 30 points from your homeworks, you don't have to join at all. Right, but it would be great to hear your voice, not only yours, but all of you. So yeah, I hate talking to my computer, seeing no one. So yeah, hopefully someone will talk to me sometime, and yeah, and hopefully next week I can see some faces. So please try to get your cameras on, so I can see at least some familiar faces because I don't want to talk to to your initials like JB or TD or whatever. Okay. Yep. What else? Okay, not if you have no questions. Okay. Okay, great. Okay, so let me check. Mr. Fang, maybe you already answered this. Maybe you already answered this.
Mr. Pham, I think it'd be quicker if I just asked like this way. So maybe you answered this already, but I wasn't present for the beginning of the seminar. If we have not submitted one of the homeworks, how many points will be deducted from the result? Like within these changes that we get 30% for the homework.
Yeah, I think I answered this question already, but I will answer them again. Thank you for your question, Elizaveta. You will have like until the end of this week to submit all homeworks if you want. Okay, I will stay.
Okay.
I will stay accept them until the end of this week. You know, from the beginning until the long-term financing homework. So if you send them to me, I will still take it. I will still give you points. But if you don't do it until the next of week, I will give you like 0 points or some points only.
Yeah, okay. I'm sorry, I just wasn't present at the beginning of the seminar. That's why I'm asking second time.
Sorry, no, I thought I explained it not clearly. So yeah.
No, sorry. Yeah, I just missed that. Thank you very much.
Thank you. Glad to hear someone at least.
Will do my best to talk to you. I hope some people will join me after.
No, sure. You should join, guys. Yeah, okay, great. So, anyone else? No, I feel like a YouTuber now. It's like, you know, the youngsters, they're playing online games and they, you know, or doing some stuff, and then they have like people watching them and people are asking questions in chat, and then, you know, YouTubers, they answer them, or Twitch guys, yeah. So at least I know how, you know, how does it feel to talk to yourself and then answering questions through chat. It goes Let's Play. I have no idea what is it. Maybe I'm too old for this kind of stuff. Okay, anyway, dude, we need to be serious. Okay, so long, be serious. Okay, so I will open the 6 seminars. The 6th seminar. 6. Okay, so I will share the screen, right? I will share the screen. Okay, if you cannot see the screen, tell me. What the hell? Okay. So can everyone see the screen, right?
Yep.
Okay, great.
No.
So.
Oh yeah.
Yeah, great. Okay. Someone is asking, so, oh yeah, I can do this like this. Yes, okay, great. So, okay, so 6th seminar, capital structure. So Professor Hurley already told you what is capital structure and why it's so important, you know, for the company, right? So just like a brief, brief theory explanation. Capital structure. If you're looking at the balance sheet, on the left side you have assets, right? On the right side you have equity and liabilities. So the capital structure is dealing with the right side of balance sheet, and the capital structure, in corporate finance, if you are dealing with a capital structure, we are asking the question, what is, how much of own money do we should have, and how much from liabilities of, or how much debts we should have. Why the capital structure is important? Because, for example, if you want to invest in, into some, if you want, in general, if you want to invest into stocks, or to buy new companies, or expand your factory, whatever, you need to answer the question, shall I invest, or shall I make this investment through my own money, or shall I take money from the bank and then finance this kind of investment? Because even though if you have enough money and you use your own money to for investment, it will not be so effective, right? For example, if in 1 year you make 1 million and you take this 10 million to invest somewhere, it will be not effective for your company. And why is that? I will explain it later. But the question is, the question in corporate finance is, if you have money and you can invest them, how much, how much portion of that money should be your own, and how much you should take from, from outside the company for the investment. And yeah, and the questions about which capital structure is optimal for the firm. For example, if the company, if you see in the balance sheet in the right side, if you have 100% equity and 0% of liabilities, is not good for the company, as I said, because you don't use your money effectively. But if you have like 0% of equity and you have everything in liabilities, in the liability side, is not good for the company as well, because you have to pay lots of interest, and it means that you don't own anything. Like everything is is through external financing, and it's also not good for a company, because more probably the company will bankrupt. Will go bankrupt soon, right? So the main question for capital structure is, what should be optimal capital structure for the company to maximize the market value of the company or of the firm, right? So Professor Hardy already explained more in details. However, the optimal capital structure is important, because if you don't know what is, because optimal capital structure for each company is different, right? Because share, for example, for Amazon, is it good to have like 60% their own money, 60% of equity and 40% like liabilities, or should it be 50 to 50? Or should it be like 100% equity and 0% liabilities? Yeah, it depends. So every company has different optimal capital structure, and the company should find the the optimal capital structure to be able to maximize market value, means maximize profit as well. And yeah, there are some like theories how to deal with the with the optimal capital structure issues. There are like two main theories. Like the first theory is called pecking order theory, and the second theory is trade-off. So pecking order and trade-off. And pecking order theory assume that companies should never take debt, right? You should invest with what you have. So for investment, you should always use your own money, your own equity, and then like in necessary cases, you should take you should take like the loan from the bank or no extra financing, but like mainly focus on your own equity for the pecking order theory. The second main theory is trade-off. It's like opposite for trade-off theory. It says that you should optimize your capital structure by by having external financing as much as you can, because because using external financing, you are dealing with leverage, leverage ratio, and it can help your return on equity, and it helps to maximize your market value. So yeah, those are two like main theories, and they somehow go against each other, but both theories have good points and have like not good points. So and so it depends on the particular company. Okay, to talk about capital structure, we always talk about optimal capital structure, and the question is how to calculate optimal capital structure for the firm, because optimal capital structure for every company is different. For example, the big corporations such as Amazon, Google, Facebook, they have lots of own equity. They keep your own money for and they mostly use own equity for financial purposes. But like small companies, they will take like loan from the bank, or they will take external financing. But it's not like the rule. Each company have different optimal capital structure, and to be able to calculate optimal capital structure, like the best way how to calculate it is through weighted average cost of capital, right? WACC. So WACC is weighted average cost of capital, and it tells us what is total cost of capital, of getting capital. Because for example, if you are getting external capital, like if you take the loan from the bank, the cost of that is what? Of course, it is interest rate, right? Because you take the loan from the bank, every year, every month, you have to pay interest for the bank. So the cost of getting external funding, getting the loan, is interest rate, or is interest, and is calculated through interest rate. Okay, so it's easy. So it is bad side of loans from the bank, for example, right? You have to pay interest. But on the other end, why getting external financing like through loans is good is because you can deduct the tax. You can deduct the tax base, so you pay less tax. So if you, for example, if you take the loan from the bank, for example, if you take the mortgage, every month you pay, let's say 10,000 for interest. So in 1 year, you have to pay the interest of 100,000 Czech crown. So that 100,000 you can deduct from tax base. So at the end of the year, you take you have to pay less tax. So this kind of leverage is called tax shield. Tax shield means that you take the loan, you have to pay interest rate, but then you can deduct the tax. So you pay less tax, and you have money for your investment
to, you know, for your company to grow. Okay, so so weighted average cost of capital is sum of, you know, cost of equity plus cost of, you know, of that, which is liability sometimes. Okay, and so we know the cost of, you know, cost of the COD, cost of debts is interest rate, right? And then you deduct and then you multiply by 1 minus tax, because it is tax deductible. So it's like cost of debt is includes tax shield, so it's 1 minus tax. But the more important or more interesting question is, what actually is cost of cost of equity? So if you have money, you take your own profit, like equity, right? So because profit is a part of equity, so you take your own equity for investment. And what, you know, how come that this kind of money which you have, if you own, will cost you? So cost of equity is equivalent to opportunity cost, right? Because your company make a profit, and that profit you use to invest somewhere. For example, if you want to build a new factory, so the cost of equity here is opportunity cost, because if you don't invest that money into the factory, like to build a factory, and you put it into the bank, you will get some some interest from the bank. So cost of equity in the weighted average cost of capital calculation is opportunity cost for the firm. Okay, but you should know it already because you did the homework and Professor Hardy explained it to you before. Yeah, so so the key things for WACC, for weighted average cost of capital, is that you need to calculate WACC to be able to find the optimal capital structure to maximize the market value of the firm. And as I said before, cost of debt is interest rate. Cost of equity, there are two methods to calculate cost of equity: is dividend growth model and CAPM, right? Dividend growth model. For example, if you issue shares, right? So you issue shares, you sell shares, you will get money. So that money will be yours, but you have to pay into a dividend. So that's why that's why dividend growth model comes into play. So cost of debt is easy to calculate because is it interest rate, and cost of equity can be calculated through or based on dividend growth model or CAPM. To calculate cost of equity through dividend model, you have the equation COE equal dividend over MPA minus IC plus G. So div means dividend, MPA means market price of stock, minus issuing cost. Like if you issue shares, if you issue shares, it will cost you something, some legal fees and all kind of fees, plus G. G is expected growth of dividends, right? So G, expected growth of dividend, is like let's say, for example, 2 or 3% each year. How to calculate expected growth of dividend, we will talk about that later within the dividend policy topic. But just for you to know, G is like how much dividend will grow each year, right, for the next couple of years. So G is expected growth of dividend. Yeah, so cost of equity can be calculated through dividend growth model. You can see it here, or you can calculate by CAPM. And how can CAPM?
Excuse me.
Yes.
Can I have a question about the formula on the previous slide? Yeah, on this one.
Yes.
So So in the lecture presentation, there's the same formula, but there's like dividends times 100, like multiplied by 100. And like, so when I was doing the calculations, I was wondering which one is correct, because there's like the difference. So
yeah, but it should be the same, right?
no, there's like, it's the same formula, but like in the denominator or whatever, like there's in the top part of the thing, there's dividends multiplied by 100.
Yeah, very good. So if you take G should be in percentages. So if you take, for example, if you multiply dividend multiplied by 100, you should have like, you should take G like 2%. But if you don't have dividend like multiplied by 100, you will have G is 0.02. This kind of stuff.
Oh, okay. Okay, yeah. Thank you.
Okay. Oh, sorry, what's your name? Very good question. You guys should always... Martin, okay.
Matthias,
you always should, you know, say your name so I can connect your voice with your name. Like, you know, it's like exercise for me. So I'm not, you know, I'm not bored, or I'm not fed up with just talking to myself. So, okay, great. So yeah, so this is how to calculate WACC, right? So WACC, cost of equity, multiplied by percentage of equity to total assets, right? And the same thing you do for cost of debts, but you multiply by portion of debt over assets. Great. And the second way how to calculate cost of equity is capital assets pricing model. This formula is very like very popular. The professor or the man who created this formula, capital assets pricing model, he won the Nobel Prize. So you know what is Nobel Prize, right? So he won Nobel Prize for economics for this research. So this formula is very important and is heavily used. Like you know, it's not like perfect formula. It has some flaws, but this formula is heavily used in market, in financial market, like for investment banks and so on. And yeah, I guess like Professor D also explained, you know, the capital assets pricing model in more detail. So here I just go through it quickly. So for COE, you can calculate, you know, based on capital assets pricing model. So how CAPM can be calculated. So CAPM is like expected return on the capital assets, right? So R is expected return, and expected return is risk-free rate plus beta multiply with the market premium. Okay, so yeah, so expected return is like obvious. I don't have to explain it. And RF is risk-free rate. So what is risk-free rate of interest? So usually it's like free risk shares or free risk bonds. It means if you invest into bonds or shares, there's no risk that you will lose your money. Right. So, for example, that if you go on financial market and you want to buy any shares, any bonds, there will be risk that you know that that share will lose its value. For example, the firm will go bankruptcy. You know, will not grow. So if you buy the share or bond for, let's say, for 10 euros, the value of bonds or share can go down, and eventually you will lose your money, because, like, you know, the price you bought and the is higher than price that you can sell. That's but if you for example if you want to buy, or if you buy government bonds, it's like free risk. It means that for sure every year you will get some benefit from it, but the interest is very small. So RF is like risk-free rate of interest. So it's like government bond, because no one expects that country will go bankruptcy, right? No one is expecting that. So it's like the most secure bonds, government bonds. That is like risk-free. Yeah, and then you have like market premium. So it's a difference between expected market rate of return and risk-free rate of return. So it's like a no-brainer here. And important is like beta. What is beta, right? Beta is like sensitivity of the expected excess asset return to the expected excess market return. So what does it mean? Like, for example, if the whole portfolio, for example, if the share of the whole market go up, right? The price of the portfolio for the whole market go up, how your share will react to it, right? So if beta is higher than 0 or higher than 1, so if the market price go up, your bond or your share will go up as well, but how much, how sensitive it will be. Like it's kind of difficult to explain it, because it's like advanced stuff. So I don't want to go into detail. But for you to know, what you should know is that capital assets pricing model is how we calculate cost of equity, and you should remember the formula. That's it. Yeah. So I'm not going into details. So I don't want to confuse you. Okay, so here we have like exercise, right? We have how much exercise do we have? We have like, well, we have like lots of exercise. We have 3 exercises, 4. So let's go through. Let's go and try to calculate them together. Okay, are you still with me?
Sure.
Okay, great.
But
so
can you take note? Like, could you write down all the exercises, like the answers?
Yeah,
and like how you,
I will do it
them
now.
there?
I will do it now.
Oh, perfect. Thanks.
Okay, so here we have like media stock company emit or issue ordinary shares with a nominal value of 5,000 with the market price of stock of 5,200. Issuing cost per share are expected to be 200 Czech crown. Dividend per share in the first year is 750 Czech crown. The annual growth of dividend is 2%. What is cost of equity, right? So can I write like directly here? Yeah, let's do it. So cost of equity, as I said before, sorry, someone sent me a note. Okay, just asking. Okay, great. So let's go back to the presentation. Okay, so you have cost of equity, right? So because this exercise this exercise wants us to answer the questions, what is cost of equity? And as I said before, there's 2 ways to calculate cost of equity, either dividend model or the CAPM. But since in the exercise you can see dividend, you can see growth of dividend, so you can expect that the formula we are going to use is dividend model, right? So how to calculate dividend model? It is dividend over okay, so I will do this, I will do this, I will do this, plus G. What is G? G is 0.02, and dividend over MPA. What is MPA? market price of stock. So it's 5,200 minus issuing cost. How much issuing cost? 750. Okay. Oh, sorry. What is dividend? Damn, we don't have dividend. Oh yeah, we have dividend. Sorry, 200.
Sorry?
Okay. Okay.
I think the issuing cost is 200.
Sorry.
Sorry, I think the issuing cost is 200.
Oh, whoa. Oh, dividend. I'm sorry. Oh, yeah. Oh, I did a mistake. Sorry. Thank you very much. Your name?
Elon.
Elon. Thank you very much. So 750 over, divided by 5,200 minus 200. Okay. So if I put this, I'm stupid. I should put this into the Excel. Let me open the Excel. Can you see the Excel?
No.
No. What the hell? How come you cannot see the Excel? Okay, let's see. I will share again. I will go for Excel. Okay. Can you see the Excel?
Yeah.
Yeah, great.
Yes.
Yeah. So I will take this like this, like this. So I will COE. So COE equal, is it correct? It doesn't seem to be correct.
It's not. It needs to be 0.02. The G.
Yeah, but I did it before. I have it here 0.02. See? But somehow here I.
You have to multiply by 2.
Multiply by 2.
No, sorry.
Is it like this, right? Why it doesn't work? Somehow because it doesn't know. Okay, so 0.02. Oh, you know what? I will do this, divide it to 100. Okay, so cost of equity is 0.17, which means 7%. So cost of equity is 17%. It means that getting money from issuing dividend will cost you 17% from what you issue. Okay, so cost of equity always in percentages. So cost of equity is 17%. Like easy. Great. If you have no questions, guys, let's move on to the second exercise.
But can you explain again what exactly the cost of equity means?
Okay, it means because you need money, right? You need money. That's why you issue shares. Because if you issue shares, so you will sell your shares. And when you sell your shares, you will get money. So if I buy the share of Amazon, for example, I will give them money, they will get money, and so they can take that money and invest somewhere. So I will get share and I will get dividend. So the cost of getting my money is like 17% from the money from the market value of that share. I don't know if it is like clear, because if you issue share, there's some issuing cost, right? There's cost of paying dividend every month. There's cost of let's say administrative costs. So because of issuing shares to get money, there will be some cost for them for issuing that money.
So actually, like if the share costs, I don't know, 100 crowns, the company will get 83 crowns out of this share, right?
Oh yeah, perfect. Yeah. It's
I'll be
like
sure.
yeah, exactly. So from 100 Czech crown, what they get from selling shares, like 70% from 100 is like cost for them. Okay. Okay. Great. Yeah. So that's cost of equity. Any other questions? If not, let's go to the second exercise. I can once again turn off share and share again. So the second exercise is to calculate weighted average cost of capital if the capital structure is 70% of equity and 30% of is bank loan with interest rate 77%. Okay. So the question is how to calculate WACC, right? Because you have average cost of capital, because you have cost of equity and cost of debt. So you have to make weighted average to be able to get like total cost. So weighted average cost of capital is D over A plus of equity. No, not plus. Multiply. So, yeah, multiply plus E. Oh, I did a mistake. EA D over A multiply with cost of debt over 1 minus T. Okay, so if I rewrite the formula, so ACC is how much is E over A? So 70% is equity. So 70% of equity means 0.7 multiplied by cost of equity. We don't know yet, so we have to calculate it, plus that assets means 0.3, right? Because E over A and D over A should always be 1. So we have like 70% capital structure, 30% of bank loan. So it's like that's right. Multiplied by cost of debt. How much is cost of debt? Man, it should be, because cost of debt is interest rate. So it's 0.07 multiplied by 1 minus, what the hell is minus? Okay, 0.21. Okay. To be able to calculate COE, this time we have market return coefficient beta. So we should take the second formula. So cost of equity is free rate return. Okay, I will write like here so you can understand it. Okay, is free risk rate. The risk-free rate is 0.03% plus how much is beta? 1.1 multiplied by Okay, so you have market return, so it should be multiplied by 0.09. Yep. Okay, great. So can anyone tell me how much is it? How much is cost of equity?
$1.02.
Okay, 1.02. 1.02.
Yeah, one.
No, no, it shouldn't be like this. No, no,
Isn't
no.
it 9 point? Isn't it 9.6?
0.
Sorry, I made a mistake. It's
No, because
0.129.
0.129. I don't know if you heard me before.
I didn't hear you. Sorry.
Okay,
So
so my microphone was off.
yeah, it happens to me like lots of times. So 0.129. Okay.
Yes.
Okay, perfect. So it's 12.9%. Okay, perfect. Thanks.
Excuse
So
me.
if I
Some of us got 9.6% from this COE. It's probably because we subtracted market return from RF, risk-free rate. Can you please explain why it's not right?
okay, well, yeah. Because here we have like RM, right? It's expected return of market minus RF, right? And here exercise says what? Exercise says we have market return, right? So what is market return here? Market return. Okay, yeah. I did a mistake. So yeah, I misread it. So it should be minus 0.03. Yep. Right. Yeah, because this bracket is market premium. The whole this is market premium, but here we have market return, not market premium. So that's why market return is like is like profit from profit from that that loan. So yeah, so 9 minus 3 is 6%. So market premium is 6% multiplied by 1.1. Okay, so it should be 9.6. Yeah, you are correct. All right, thanks. So we put 0.096 in here, and we should have, okay, I don't know. Let me change it to put it into the Excel, and the result should be, why doesn't work? Tadi dash plus. Okay, does anyone have the result? Okay, let me do it in the
8.4. .4.
8.4. Yeah, I'm just checking it. So okay, so everyone got the same thing? 8.4. Yeah, so do you still see my screen?
Yes.
Okay,
Yes.
great. Yeah,
Same
thanks.
thing, same.
Yeah, so the cost of getting bank loans on the cost of getting bank loans and spending your own equity is like 8.4%. Right. So yeah, and of course, the lower is WACC is better. Right, the lower the better. So, for example, you can change it to 60% and 40%, and you can calculate the same thing. And for example, for the new WACC with the new structure, it can be, let's say, 7.4%, for example, right? This number is dummy number. 7.4%. Okay, so for example, if you change the capital structure to 60 to 40, you will get new WACC, and you will choose the structure, the capital structure with lower WACC. Okay, so you can like playing with the capital structure percentages to see when you will get the lowest WACC. That's my point. I can hear someone. Can you please mute if you are not speaking? Eric, please. Eric, can you mute yourself? Okay, thank you very much.
Yeah, I do. I'm sorry, it was.
That's okay. That's okay. So, okay, for this, see, here you have to calculate again optimal capital structure. So here we do the same thing, right? We do the same thing. So the company, they have like the company has three possibilities, right? So the company has three options to have, to have capital structure. The first option is to have like cost of equity of 15%, interest rate of bonds 8%, bank loan 7%, right? And the second option is cost of equity is 13%, and so on and so on. And the question is, which option is the best for the company? So which capital structure is the optimal capital structure for the company if they have these three options? So this exercise is very similar to this exercise, to the previous one. So I'm not calculating it here since you know the formula, right? You know the formula, so you just put it there and you will get it. So can anyone tell me which option is the best?
Just we actually can't calculate this because we are missing the tax rate for
Yeah,
this exercise.
Tax rate is 0.
Is it 0? Okay.
Yeah, as I mentioned before, if you have no tax rate, if there's no mention of tax rate, it's 0.
Okay, thank you.
Okay. So, does anyone have the answer?
The third one.
Third one. Thank you. Who else?
The first one.
First one. Okay. Why? So why do we have two different answers? So can anyone else please shout out? First one. Okay. Kyo said first one. So everyone agree with the first one? Okay, so I will highlight this. It's like It should be the, it should be, okay, so third one, third one, third one. So everyone is saying third one. So this is not correct, and this should be correct. I'll highlight it as green. Okay. Okay, so like 5 people said third one. So yeah, so sorry, Q. It is third one, not first one, but third one. So the green one. Okay. Okay, great. So let's go. Let's third one. Perfect. Yeah, thank you. So the last exercise is calculate weighted average cost of capital. The cost of equity is 18% and the cost of borrowed capital is 14%. Value of indicators of financial leverage is 4. So it is a very easy question, like yeah, very easy, but I got some you know, some questions about it because lots of people wasn't able to calculate it. So okay, I will show you. I will show you now. Okay, so it should be easy, right?
Isn't it just from the formula? Like, we just put the numbers in the formula.
Which number? So how would you do it? Can you tell me how would you do it? So yeah, so please tell me numbers.
So we use the cost of equity.
Cost of equity
which
is how much?
0.18.
Perfect.
And then multiplied by 0.18 over 0.14.
Over 0.14, like this?
Yeah, I think so. No, wait, we don't have equity here.
Yeah, exactly.
Oh, so then without this, because this is already a cost of equity and we don't have the, like we have it in percent.
Yeah, so how? Okay, the easiest thing to do is to find out financial leverage. How is financial leverage calculated?
Debt over equity.
Assets over equity. Perfect. Who said that?
Sorry, Yuna.
Okay, thank you. So if you have A over E is how much? Is 4. It means E over A should be how much? Yes. So E over A is 1.4. It means D over E should be how much? Exactly, right? Perfect. Yeah, great. 1.4. So in that case, you put it here. You have 3 over 4 plus cost of, so it's 0.14 multiplied by 3 over multiplied by 3 over 4. No, it's not like this. It is like this. Yes? Does anyone agree with me? Yeah. So what is the answer, please? Ziyuan, 0.15. Hopefully I pronounced your name correctly. So it's 0.15. So it is 15%. Yep. 10.0. Okay. So
Excuse me, sir.
yes.
Is the financial leverage equals asset divided equity, or it's debt divided by equity?
Sorry, you're asking about financial leverage?
Yeah.
So your financial leverage is assets over equity.
Oh, okay.
Financial leverage is assets over equity is 4. So if you want to like convert it, so you want to have E over A, it has to be 1.4. Yes?
Oh, okay. All right. Thank you.
Yeah, because like yeah, you have E. So if you move E up and A down, you have to do the same thing for number 4. So we change it to 1.4. Yep. Yeah. So this exercise like super easy. Just know what is financial leverage, and we should know it. You can Google it anywhere. So yeah, that's it. Oh damn, it's already 5:45. Okay, so it took me more time than I thought. However, doesn't matter. We just go through the optimal structure. So yep, any questions, guys, for optimal structure? So yeah, so since we have to finish it now, next week we will continue. We will follow the path of the lecture. Next week I will go faster, and we will cover 2 topics. All right. Next week we will cover long-term financing, and we will cover valuation. Okay, guys. Okay, guys. So yeah, that's it. I hope you understood the seminar, understood the exercises. Now you see that it's not difficult at all, right? Yeah. So do you have any questions, guys?
No.
Okay, great. Everything clear?
Yes.
Okay, great. So yeah. So I will stop sharing, and yeah, let's see how many people here. It's like 20. It's like 15, 20. Whoa, it's like 27 people. 2, 4, 6, 8, 10, 30. Yeah, 28 people at least. Thank you very much, guys. I appreciate your time because outside is like super nice, super sunny day. So it's it's very good that you stay here. Like I still guess like most of you just turn on the Teams and then go out. So I think like actually here's only like 5-6 people, but it's still okay. Thank you very much, at least for joining. And if you have any questions, yeah, send it to the group chat so everyone can answer it. I can answer it. And if you have no questions, see you next week. Oh, and please, please, if you have cameras next time, please turn on your cameras. Don't worry, no one will laugh at you.
So if you turn on your cameras, I will turn on my camera.
Bye. Thank you very much.
Thanks. Bye.
Thank you. Bye.
Okay, bye. Have a nice day. Go outside, guys. Yeah, don't stay.
Okay, bye.
Don't
Thank
stay
you.
inside. Bye.
Bye.
Sure.
Okay.
Bye.